Good morning, everyone, and welcome to all of our valued clients and friends. I'm Michael Matheson with M2 Financial, and we're very excited to share Outlook 2026 and some high-level thoughts about where economists at LPL believe things may be heading for this upcoming year. As always, nobody has a crystal ball, as I always wish that I do, or no one really knows how things are going to go, but we hope that some of the insights we're going to provide today will give you some insights into what we're thinking and how this helps guide the advice that we give to you. We have a big crowd today, so we promise to keep this hopefully full of valuable information and things that you'll be able to take away. If you have any questions at the end, feel free to drop us a note directly, and we'll get back to you on a personal basis. So when we think of an outlook, I think of things like where are we? And we are now and have been in a period of uncertainty and volatility for some time. The theme of today is the policy engine, and the policy engine is what's really running the economy. And we're going to highlight some of the factors that could play into 2026 economic results. So let's talk in general. While the U.S. economy is expected to be and should be a little bit sluggish in the first half of 2026, it's also expected to avoid a full-blown recession due to the tailwinds of easing monetary policy and business-friendly dynamics within the One Big Beautiful Bill. The lagged effects from a slowing job market, softer wage growth, and nagging inflation will dampen growth a bit in the first quarter of 2026, but as businesses and households regain their footing from uncertainties during 2025, we expect 2026 to grow close to 2.1%, higher than 2025, but not as fast as 2024. So let's talk about fiscal spending. There's been heavy fiscal spending and really strong business investment in artificial intelligence, and we really can't avoid that. Every time we turn around, we hear about AI and artificial intelligence. The need for infrastructure is expected to provide crucial support for the economy. The insatiable demand for cutting-edge technologies like data centers, advanced semiconductors, and AI-driven software is fueling significant capex by tech giants and businesses across various sectors. The demand for intellectual property will be a pillar of growth this year, we believe, and we expect IP will have an increasing slice of the economy as we move forward over time.
Thanks, Mike. Like AI, inflation has dominated headlines. Inflation will not likely decelerate as fast as policymakers would hope, yet we still expect the Fed will continue its rate-cutting campaign in 2026 as it balances inflation concerns with risks to the labor market and overall economic growth. Ongoing factors such as new tariffs could push general inflation slightly higher, but softer household demand will cause inflation pressures to recede in 2026. But in the near term, investors will have to bear the burden of hotter inflation. Mortgage rates are primarily influenced by long-term interest rate dynamics, which are shaped by the fiscal outlook and the 10-year U.S. Treasury yield, rather than just the Federal Reserve's short-term policy rate. When fiscal policy results in large deficits and heavy Treasury issuance, investors often require higher yields to compensate for increased supply and inflation risk, pushing mortgage rates higher. But 2026 should be a year of declining mortgage rates, creating some support for home buyers. Geopolitical and trade uncertainty will stunt the Eurozone's economic growth. High relative energy costs, coupled with broader structural weaknesses in productivity and technological capacity, limits the Eurozone's international competitiveness and risks constraining growth below U.S. levels. Plus, many member states are implementing fiscal tightening measures, which act as a drag on growth. Japan's goal of the virtuous cycle of sustainable inflation driven by robust wage growth looks more likely in 2027 than in 2026. The nagging questions for investors are the pace of future rate hikes and the timing of the terminal rate, which is complicated by ongoing global economic uncertainty and the government's desire to support growth.
Thanks, Marie. Now on to stocks and talking about how policy tailwinds and AR are to power equities going forward. The S&P 500 surged more than 80% over the first 3 years of this bull market, excluding dividends, far outpacing historical averages. If history is a guide, then this bull market may have more room to run. The S&P has averaged 12.8% gain historically during the fourth year of bull market since 1950, with 6 positive years out of 7. In previous instances, when the Fed cut rates and stocks were at a near record high, 28 cases, the S&P 500 was 13% higher on average 12 months later, with 93% of those 28 periods producing gains. When the U.S. economy was not in recession around a rate cut, the average 12-month return for the S&P 500 increased to 18% with gains in all 21 periods.
Yeah, the consensus estimates for 2026 CapEx from the five hyperscalers is expected to approach $520 billion, a roughly 300 or 30% increase over this year's estimate, and an estimated 1.6% of the US economy measured by nominal GDP. In terms of dollars that can help drive the economy and corporate profits. Nothing is bigger than AI right now and is very unlikely to change anytime soon. The Magnificent Seven has been responsible for more than half of S&P 500 earnings growth the past few quarters and will likely continue to play a significant role in growing earnings in 2026. The wide gap between the Magnificent Seven's earnings growth and the rest of the market will likely persist well into 2026, supporting large cap growth stocks, but monitor the gap potentially narrowing. One of the clear things on the horizon and the 2026 economic results are the midterms.
Yeah, midterms. If there's been a question that we've been getting on the regular just since the calendar flipped into 2026, is that how could the midterms impact the economy and the markets? The Republican majority in the House is razor thin as they hold just 219 seats, one more than the 218 needed for control. This represents the slimmest margin since 1931 and significantly increases the risk of a shift in power next fall. In 20 of the last 23 midterm elections, the president's party has lost seats in the House, with an average decline of 27 seats. Historically, mid-years have been challenging for equities. Since 1950, the S&P 500 has averaged a modest 4.6% gain during midterm years, with an average maximum drawdown of 17.5%, making it the most volatile and weakest performing year in the 4-year presidential cycle. Once political uncertainty subsides, markets tend to rebound.
Thanks, Mike. While markets are rebounding, bonds are navigating neutral. Market pricing suggests that the Fed's rate cutting campaign could end by the second half of 2026 with a rate of around 3%. If market pricing is right, it's likely the 10-year Treasury yield will remain around 4%. It's unlikely the Fed will cut rates to levels that would take the 10-year Treasury much lower. Thus, we think a 3.75% to 4.25% 10-year Treasury yield range for 2026 is appropriate, at least for now. Upcoming, likely dovish, changes to the Federal Open Market Committee should help prevent the 10-year yield from drifting meaningfully higher.
Despite recent challenges, the broader credit market is not in crisis, nor do we think that we are on the cusp of systematic credit issues. Our issues is with market valuations, credit spreads, or the additional compensation for owning risky debt, remaining historically tight given these rising unconventional risks. While yields may appear attractive, spreads remain below long-term averages and are arguably not providing sufficient compensation to take on these emerging credit risks. Agency MBS and investment-grade corporates should outperform Treasury securities given the higher starting yield for both asset classes, but given our view on rising unconventional risks within the corporate credit markets, we still have a marginal preference for MBS over corporates. As the Fed continues to cut short-term interest rates, cash yields will come down as well, which should allow high-quality fixed income markets to outperform cash holdings once again. A stable or slightly higher interest rate environment or even tighter spreads are needed for high yield and leveraged loan sectors to outperform core sectors.
Yeah, thanks, Scott and Marie, for the update on the bond market there. And now moving on to alternative investments and how to seek resilience through alternatives. M&A activities, which ties heavily into the alternative investment space, has been trending up both in terms of the number of deals and the value of the deals, supported by the deregulatory policies, rate cuts, and increased demand in AI-related transactions.
In addition to M&A activity, let's talk about another alternative, currency, specifically the US dollar activity. Despite recent volatility, the dollar's long-term uptrend remains intact. The 2025 drawdown found support from a secular trend dating back to 2011. A sustained move above 100.35 could confirm a short-term bottom, targeting the 104 to 105 range. Speculative positioning and sentiment are improving, suggesting potential upside from short covering. To break the long-term uptrend, the dollar would need to fall below the September lows near 96. That would likely signal a new bear market cycle, shifting from consolidation to a resumed downtrend. Key downside risks for 2026 include escalating trade tensions, a weakening U.S. economy, and capital rotation into outperforming international markets.
Thanks, Marie. Let's talk about another alternative investment space in commodities. Several macro catalysts could support commodity prices. Potential rate cuts and lower treasury yields may weaken the dollar, providing a tailwind for commodities. Stimulus from the OBBA and a possible recovery in China could further boost demand. Trade policy remains a wild card. Additionally, the green energy transition and surging investment in AI infrastructure are expected to drive sustained demand for several commodities. While these factors could collectively push commodities into a supercycle, headwinds remain, such as a bear market in oil.
Yeah, and gold remains a consistent outperformer across commodities and has even exceeded the S&P 500's return since its bear market low in 2022. Russia's invasion of Ukraine in early 2022 and the seizure of over $300 billion of Russian dollar reserves prompted a swift central bank pivot to sanction immune assets. Gold has been a major beneficiary as central banks have continued to ramp up purchases with no signs of slowing down. Gold prices have been further supported by safe haven demand stemming from conflicts in the Middle East, trade policy uncertainty, and even the passage of the OBBA, which renewed fiscal deficit concerns. And these are just some of the highlights we see happening in 2026.
Again, we'd like to thank you very much for joining us today. I made a list of just some of the terms: inflation, bull market, interest rate, geopolitical risk, commodities, credit risk, supercycle, bear market, gold, M&A, A&I, currencies, trade policy, OBBA, gold, et cetera, et cetera, et cetera. And as you can see through the presentation, there are so many factors that are out there that will determine the outcome for 2026. We hope that by diving into some of these, that's given you a little bit of insight to specifically what we're thinking when it comes to investment policy formulation. And we are so fortunate that we have our team at LPL in the background helping us with this, as well as other partners. Again, as always, if there are any questions about anything that you saw today and how it may impact your specific situation, please let us know. But also know that as we are thinking forward about our investment policies and strategies, we are doing that with you in mind as an individual and how each of these components that we're talking about fit you. So again, on behalf of all of us advisors and our team here at M2 Financial Group, we want to thank you for taking the time today. And as always, never ever hesitate to reach out if you've got any questions or things you'd like to chat about. Thank you again for attending and taking the time today. And for those of you in Minnesota, stay warm. For those of you in Florida, kind of stay warm. I heard it's a chilly 55 degrees down there, so get those blankets out. Again, thank you all for attending and have a fantastic rest of your week.
Thank you.
Well, that's over.
You don't take any action.
No, we can't because compliance doesn't let us.
You have a lot of people.
36.